As a finance professional in a disrupted business landscape, what does it take to be in demand? What does it take to attract great paying international roles? If you're an ICAN member, it'll just take one exam. That's all it takes to complete the globally recognized SEMA professional qualification and the internationally respected CGMA designation. As a SEMA member and a CGMA designation holder, employers will look at you as a finance professional, constantly acquiring new skills to add value to the business. That's why they'll be willing to pay premium to hire and retain you. If you have 5 years of relevant experience and are an ICAN member, you can directly sit for the final exam of the SEMA Professional Qualification, the Strategic Case Study exam. Start studying the SEMA Professional Qualification. Prepare to make an impact.
Good evening, my professional colleagues. Good evening, friend of the Institute of Chartered Accountants of Nigeria. Our students, we want to welcome you, ladies and gentlemen. This is another episode of ICAN on Air. This day, Thursday, the 26th day of the month of January, 2023. Gradually, the month is winding up and we are coming to the end of the first month. We sincerely want to appreciate you for staying by with us all the time to make sure that we meet you as we bring you topical issue. Today, I've come with another topic that is very, very insightful, and we need to know more with a vast and an erudite scholar to do justice to it. And the topic is the effect of worsening inflation on the capital market. And to do justice to this is a friend of the house. He's been here before and an erudite scholar when it comes to capital market. No other person than Professor Uche Iwaleke. He is a financial economist and a renowned professor of capital market at the Nasarawa State University, Kefi, where he was at various times the HOD Accounting Department, HOD Banking and Finance, Deputy Director of Research, as well as Director of Quality Assurance. He holds a BSc in Accounting, MSc in Economics, and PhD in Finance, a Chartered Stockbroker and Fellow of the Chartered Institute of Bankers of Nigeria, CIBN, and also a Fellow of our Noble Institute, the Institute of Chartered Accountants of Nigeria. Before joining Nasarawa State University as the pioneer academic staff, he worked as the head of research at Lombard Asset Management Limited in Abuja. He has served as the chief economist and director at the Nigerian Security and Exchange Commission and a member of the Nigerian Stock Exchange Advisory Committee, a former commissioner of finance in Imo State, and also a former member of the Nigerian Federation Account Allocation Committee, FAC, post-mortem group, a council member of the Chartered Institute of Bankers of Nigeria, and currently sits on the board of Cowry Treasury Limited, a subsidiary of Cowry Asset Limited, as an independent auditor director. He has served in various committees for our great institute, from the Student Affairs Chief Examiner in the ICAN Business and Finance paper. And he has equally shared a lot of ICAN recognized visits to tuition center. a former chairman of the editorial board of ICAN Abuja district of the student of the society Jonah is the pioneer president, Association of Capital Market Academics of Nigeria, and the chairman of the Chartered Institute of Bankers, Abuja. He has authored and co-authored over 60 articles in peer-reviewed journals, as well as 10 books, especially in the area of finance and capital market, including the popular book called The 10 P's of the Nigerian Capital Market. He's happily married and blessed with children. That is our guest for today. Like I said, I brought for you Professor Uche Iwaleke. That is an authority when it comes to capital market. Before I come in with my guest, let me reemphasize again that this is a platform where you can showcase your goods and services, and our cost is very minimal, where you can promote your goods for it to be globally known everywhere that needs to be known. And that brings patronage to you in any how you want to look at it. I'll be going on a very short break. And when I'll be coming in, I'll come in with our guest when we'll be doing justice to the topic of today. Please get your pen and paper, get prepared, because Prof is going to do justice to the topic of today. Don't go anywhere. Stay tuned. I'll be right back. Welcome back, and it gives me great pleasure to welcome our guest for today, Professor Uche Iwaleke. Good evening, and welcome on ICAN on Air this evening, sir.
Yeah, good evening, Olu. Good evening, professional colleagues. Good evening, viewers.
Yeah, let me use this opportunity. This is the first time I'm guesting you this year to say compliment of the season, sir.
Thank you so much, Olu. Happy New Year.
Yeah, let's move on. And I start on this note, looking at the topic, which is the effect of worsening inflation on capital market. Sir, inflation as a macroeconomics variable is generally viewed as a sour or bitter pill that must be put under control. But nearly all economics, its negative effect has dimmed all the smiles of Nigerians and Nigeria itself. As a professor of finance and capital market, our global audience will be happy to share from your wealth of knowledge and experience. And I will be starting this way in a simple term. Prof, what do we call inflation?
Thank you, Olu. Of course, I'm pretty sure every uh, accounting student, accounting graduate, accounting professional, understands what inflation, is. When we talk about inflation, we are referring to um, a rise in the general, price level. When you notice that domestic prices are rising, particularly persistently, then of course that gives cause for worry. So generally, inflation is a rise in the general price level, and of course we know from even from theory that there are two basic reasons why that can happen. We have the one that is called the demand pull inflation from secondary school. That's what we learned. In
Mm,
demand pull inflation, you have too much money chasing too few goods. And then cost push inflation is a situation in which you have costs of production, driving this general increase in the price level, such as maybe rising wages, for example, can lead to inflation. So
mm,
it can be demand pull, it can also be cost push.
mm.
I think I will expand on that further as we go on, particularly with respect to Nigeria. I should be able to say what is the situation with us in Nigeria. Is it
Of
demand
course.
pull or is it cost push? Maybe as we go ahead, I will elaborate on that.
That is a great way to start, Professor Waleke. And like I said, our viewers have picked their pen to note because I know you'll be taking us to class. I go further by saying that the global economy, individual economics have been struggling to tame inflation using different approach or mechanism. You've talked about the demand push, the cost push. We want you to run us through the different factors that are responsible for persistent and high inflation rate in Nigeria and the extension of the global environment.
Yeah, thank you so much, Olu. Now, just as you rightly said, the inflationary pressure we are witnessing in Nigeria today has a number of drivers. You can talk about the global drivers, particularly the issue of the high energy costs that we are noticing in developed economies on account of the Russian-Ukraine war. So the high energy costs in particular have resulted in higher inflation rates in developed economies, particularly the US. You recall that at some point, inflation rate in the US went above 10%. In the UK, as we speak, it is also in the Eurozone and the UK, we also have unprecedented high inflation rates touching 10%. Um, so all that have been on the back of the Russian-Ukraine war, largely. And of course, when you have inflation, high inflation rates in a country like the US, and you are importing from the US, of course, it means that that will also affect you because you are importing from a country that's experiencing high inflation rates. So to that extent, we have the imported inflation. Then domestically, earlier on I talked about demand pull and the cost push.
Cost
What
push.
has been noticed is that in Nigeria, the inflationary pressure is coming more from the supply side rather than the demand side.
Mm,
Um, we have everybody knows we have rising cost of energy, which is also the situation in developed markets.
globally.
Today, you know that the pump price of fuel is rising. A lot of people cannot buy fuel, and when you have that kind of situation, of course, you should expect that firms will transfer the high cost of transport, high cost of buying diesel. All this will be transferred, to the ultimate consumer. So high cost of electricity, high cost of petroleum products, um, coupled with of course the if you like the Gordian knot. What has appeared to be the Gordian knot in Nigeria today is insecurity. So insecurity is also fueling inflation. How? I said supply side is
Yeah.
affecting output. Is affecting output. As we speak, Olu, the inflationary pressure is coming more on food. It's more on
Mm.
food. Food
Mm.
inflation is above 23%.
23, yeah.
The general inflation rate, the average, what we call headline inflation, the average rate, according to the National Bureau of Statistics, the December figure came in at 21.34%. 21.34 represents the average. The National Bureau of Statistics computes inflation using a basket comprising 740 commodities. Okay, and the average, as I mentioned earlier, is 21.34. But if you disaggregate that number, okay, let me also say that there are two components of that. You have the one that is called food inflation, which I mentioned is over 23%, and then core inflation. Core inflation excludes the volatile agri products. The core, that is the cost of things like furniture, cost of clothing and so on. The price of that fall under core inflation. Okay, core inflation is around 18%, is below the average. So that tells you that the problem is actually coming from food, over 23%. And as I said earlier on, if you disaggregate that, you find out that in places like Kwara State recorded the highest rate of food inflation in December at
Mm.
27.9%.
Mm.
While places like you also have places like Sokoto, for example, recording relatively low food inflation rates, okay, of about 20.9. But what is important is that food inflation is the one bringing this pressure. And why is
Mm.
that so? It is principally so because of insecurity, because of
Mm.
farmer sellers clashes, and because of banditry, kidnapping. These, crimes, various types of crimes, are not allowing farmers to go to farms, particularly in the food belt areas of Nigeria.
This is
Recently, we can see what is happening in Benue, what is happening in other food belt regions of the country in terms of insecurity. So that is what is fueling the food inflation.
this
Uh,
this is great. And yeah, it's great. It's great, my
I see.
prof. Let me just quickly interject you there because we are still riding on it. Based on the explanation you just gave now, this worsening inflation rate, how does it affect the economy in general? Spoke about the food inflation, the coin. How does it affect Nigerian economy in general, sir?
Oh dear. Of course, that cannot be, the effect of inflation cannot be overemphasized. Inflation, if you like, is an ill wind that blows no one any good. Inflation reduces the purchasing power of currency, of money. Um, so it reduces the purchasing power of money. And perhaps the only group of people that benefits from inflation, um, happen to be borrowers. It's only the debtor that you can say and benefits from inflation, because of course when he's paying back the money he borrowed, he will still pay back without factoring in inflation. But the impact on the economy is negative to the extent that it reduces the purchasing power. So aggregate
Mm.
demand usually drops, and it affects because aggregate demand drops. You should expect that it affects economic growth. It affects GDP. Okay, so if if you were on a fixed income, say minimum wage of 30,000 naira, and then your minimum wage is experiencing erosion um, in value as a result of inflation, of course, you won't be able to make purchases that you used to do. So
Mm,
inflation weakens purchasing power, reduces economic growth, and of course, as I said earlier on, even contributes to poverty level.
mm,
When we talk
mm.
about the poverty index, misery index is a function of high inflation rate. Inflation rate is rising. You should expect that the um, you know welfare of the citizens will be adversely affected.
That is awesome. This inflation seems to be like a masquerade that we need to deal with, so that we can improve the purchasing power and then lift our people more out of poverty. Let me use this opportunity once again to welcome all our viewers today. Possibly because I'm guesting Professor Waleke. I've seen a lot of viewers all the way from Nasarawa. Yeah, I can see them from Nasarawa, Abuja, Delta, Bauchi, Kano, Benin, Port Harcourt, Lagos, Ibadan, Zaria, name it. Every part, everyone is connected because this inflation, we need to nip it and we need deeper understanding. So let me welcome some of your questions. I'll be taking them as I progress. But Prof, let me quickly take this question before I welcome the question of my audience. In 2022, that just ended, the stock market in Nigeria performed relatively well despite high inflation rate. How does inflation impact the capital market?
Yeah, thank you, Olu. I'm I'm going to take that. I don't know whether to take the question I'm seeing on the screen first or to answer your question
No,
directly.
I'll come back to the question on the screen. So just take my
Okay,
time.
fine. All right. Well, of course, the capital market is a market where companies and the government go to raise money, go to raise medium to long-term funds. Okay. Just like any financial market, what it does is, it pulls, uh, from surplus units and then channels these funds to, deficit units. The surplus units are the investors, okay, and deficit units are the borrowers, the people raising funds, whether they are companies or the government. Now, what that means is that you have the capital market provides an avenue, a platform for investments. So you have investors in the market. These investors are either foreign investors or they are domestic investors. Now, within that category too, you have institutional investors. Institutional investors are um, investors like pension funds, mutual funds, insurance companies. These are institutional investors in the capital market. And of course, you have individual investors, retail investors, rather. Okay, you and I. Now, let us be practical about it. You want to invest in a company, okay, or you want to buy shares, or you want to buy bonds. Any investment you want to make, you are considering what? You are looking at the return on that investment. Is that not so, Lu? It is a
Yeah.
return on the investment. So if you are deciding to buy some company shares, you're looking at the return. And what is that
Mm,
return? Return has two components with respect to shares or equities. The two components are, number one, you
mm,
stand to get dividends at the end of the day if the company pays dividends. And number two, if the price of what you have bought appreciates
mm.
over and above the cost price, of course you can sell. So you have
Yeah.
return being made up of dividend plus capital appreciation. Now that return must also be viewed in the context of inflation rates. If your return on investment is 10%, and inflation rate is running at 20%, it means you have not really gained.
Again.
Your
Yeah.
return on investment is negative. So we say the real rate of return is negative in the example I've just given, if the return is running below inflation rate. So you can see the way it impacts the capital market
Capital markets.
and participation in the capital market.
Mm,
If inflation rate keeps rising, okay, it depresses it reduces investors' sentiment. It weakens your sentiment. It doesn't give you the urge or the incentive to invest, because you know that even when the return comes, the inflation will have eroded it. Okay, so that's why you find people now looking for things, places like Ponzi schemes, schemes that will give them, mouth-watering returns that will be higher than inflation rate. So inflation rate has adverse consequences for the capital market. As I said, it except when you have a rate of return that is above the inflation
The
rate. That's the
inflation
only
rate.
time. Exactly. That's the only time you can be comfortable, and then you can also be incentivized the more to invest in the capital market. So, of course, what I've just said is not uh, peculiar or to the capital market. All types of uh, asset classes, including the
Asset.
ones we have in the money market. Yes,
Hmm.
you wouldn't be investing in the money market if inflation rate is so high and
Above your
eroding.
returns.
Exactly. So that's
Hmm.
where you can
Hmm.
see that inflation rates, persistent high inflation rates, particularly when they exceed double digit, they are not really in the interest of the economy. And that's why the
Hmm.
central bank has a band. The central banks of Nigeria's band is between 6% and 9%. That is what they consider ideal. But of course, you know that over the years, the central bank has not been able to bring inflation down to single digit level, within the band that they have set. That is between 6 and 9%. In the US, for example, the Federal Reserve, that's the central bank of the US, has a target of 2%. And that is why
Hmm.
what is happening now is of concern to the Federal Reserve, because for, for the first time in many years, inflation rate in the US has gone well above the target of 2%,
Two
which is
percent.
why the Central Bank of the US, the Federal Reserve, the Federal Open Market Committee, each time they meet, they met recently and also jacked up their own benchmark policy rate called the Fed Fund rate. So they keep increasing rates or tightening monetary policy to bring inflation rate down.
Yeah.
And we
Hmm.
have also seen in the case of Nigeria, the Monetary Policy Committee met, the other day,
A
and
few days ago.
against our expectations, also increased the monetary policy rate.
The
Uh,
monetary year.
Yes, to 17.5% now, which of course is high, by all standards. So, but they have done that because of the need to really stem inflation and really, bring it down to, manageable level, because inflation is one cankerworm, if you like, one macro variable that gives any central bank governor, real headache. Because
Hmm.
come to think
Hmm.
of it, that is their primary mandate, to maintain
Hmm.
price stability and to ensure that inflation is within targets that they have set. So inflation rate is not good for financial markets, whether money markets, or capital markets, and that's why it needs to be tackled. It needs to be reined in, by the monetary authority.
That is a brilliant way to explain that weight we have brought before Professor Waleke. For those of you that are just joining us, I've been guesting an erudite scholar when it comes to capital market finance. Maybe it is always there, Professor Uche Waleke. And let me take the first question from Bamidele Gideon. He's asking, which of the two factors is driving inflation in Nigeria?
Yeah, thank you, Olu. Remember, I talked about demand pull and
And
cost
cost
push.
push.
And the question
Yeah.
now is, which of them is driving inflation in Nigeria? What we know from evidence, and this evidence is also empirical, is that inflation rate in Nigeria is being driven more by the cost push factors. I mentioned the cost of petroleum products, cost of
Mm,
rising cost of electricity, cost of transportation costs, and then of course all these are also fueled by insecurity
insecurity.
that's also affecting the food production. I said it's more of supply side factors. But that is not to say that we don't also have demand side factors. This one became evident recently when the central bank governor said that 3.2 trillion naira, as of I think November last year, was circulating outside the banking, system. So, sorry, 3.2 trillion represented currency in circulation, out of which over 80% of that, or 2.7 trillion, was circulating outside. So, when you have again increase in money supply, currency in circulation is part of money supply. Money supply is defined as either narrow money supply or broad money supply. Narrow money supply is currency in circulation plus the demand deposits. While broad money is narrow money, when you now add savings and time deposits, and also some foreign currency deposits, you now have broad money supply. So when you have too much money in circulation, when the money supply is high, it can also affect inflation. So the central bank is also saying that there is also an aspect of inflation that is caused by too much money in circulation, which is also why part of why the currency redesign is being put in place, which is also part of why the cash withdrawal limit is being put in place, so that the central bank can have control over currency in circulation. When so much money is circulating outside the banking system, the central bank, will not have control over the money supply. And when the central bank doesn't have control over money supply, implementing monetary policy becomes difficult. The transmission mechanism becomes difficult. So central bank wants to have a handle over money supply. Otherwise, it will fail in its function. But if you want to look at it on a balance, the one that is affecting inflation rate the more is cost push, the supply side factors, yes, and not the demand side factors, which is why some of us are arguing that inflation, the best way to tackle inflation in Nigeria is not by increasing the monetary policy rates, taking it to a very high level. That the best way is to tackle those supply side factors, since they are the ones exerting more pressure on inflation. So we need to tackle insecurity. We need to tackle the issue of fuel imports. We shouldn't be importing fuel in this country. And we also need to do something about power. If we tackle all this, okay, supply side issues, structural bottlenecks, you can be sure that inflation rate, food output will increase, because that's where the pressure is, and then inflation rates will come down.
That is awesome. Sincerely speaking, I've been jotting down several things as I have my prof discuss with me. Before I go back to my own highlight, let me quickly recognize the question from Fagbola from the ancient city of Ibadan. He's saying that inflation tracks the rise in the price of goods and services, which in turn shrink the purchasing power of Nigeria, just like you explained. He is asking what to do by the government and the governed to arrest this uncertainty.
Yeah, so it's something I'm pretty sure our professional colleague Fabola sent in that question before I
Before your
finished.
last explanation.
Yes, my last statement. Yes, I said it, that inflation in Nigeria is not just a monetary phenomenon. So it's not just what we leave in the hands of the central bank to do. And that is because the cost of inflation cuts across both the monetary and the fiscal side. It is not the central bank that has responsibility to tackle insecurity. It is not the central bank that should deal with the issue of fuel imports. It's not the central bank too that should fix power. These are issues in the domain of the fiscal authorities. Okay, what the central bank can do and is doing is to address inflation using monetary policy tools. What are these monetary policy tools? One, the very popular one central bank has been using is the monetary policy rate. Okay, which is why between May last year and January this year, the the central bank has increased the monetary policy rate by 600 basis points from 11.5 in May last year to now 17.5, all in a
17.5.
bid to do what? To fight inflation.
Mm.
Okay, so we have also seen this in some other countries. In the US has increased the benchmark policy rate, the Fed fund rate, from near 0% to where it is today, between 4.25 and 4.5%. In the UK, in the Eurozone, is also the same story. The central banks have been tightening monetary policy, all in a bid to bring down
To
inflation.
stem
But it
inflation.
has consequences. When you tighten monetary policy and you keep raising interest rates, the consequence is that it could also lead to a recession. Because it leads to shrinking of output. How? Cost of borrowing becomes expensive. Businesses won't be in a position to access credits, a lot easily, and then the economy begins to shrink. And that is why there has been this prediction that the economies of the US and some central and some developed economies, if they continue to tighten, that they would risk having a recession.
Recession.
So, in our own country, Nigeria, today, as I said, the central bank has been using monetary policy rate. There are other tools. Apart from the monetary policy rate, there is also the cash reserve ratio. The cash reserve requirement in Nigeria is very high at 32.5%. You also have liquidity ratio at 30%. Now, beyond these ones that are usually read out in monetary policy communique, including the asymmetric corridor of plus 100 minus 700, the central bank too uses open market operations. I'm sure you know open market operations to also mop up liquidity from the system when it thinks that there is so much money, the money supply is high. So central bank has a number of tools that they can use to fight inflation. But the problem with the tools in Nigeria is that the tools can only address the monetary side of inflation. The tools cannot address the supply side or cost push side of inflation.
Of
Central
inflation.
banks tools are only designed for the demand side and not the supply side.
Mm.
And which is
Mm.
why we are saying that the central bank alone cannot fight inflation.
Mm.
No matter how
Mm.
much they increase interest rates, inflation will not come down significantly until the supply side factors are addressed. And it is the duty of the government, not the central bank, to do that.
Mm.
Okay? It's the duty of the government to tackle insecurity. If banditry is dealt with in Nigeria today, farmer sellers clashes are dealt with in Nigeria today, and you see the agri sector, begins to improve. You have improved
To
output.
boom.
Yes, but to boom, inflation will come down because inflation is more on the pressure is more on food. Okay, if you look at the National Bureau of Statistics data, the latest one they released, quarter three 2022, go and check. The agri sector has been declining. Okay,
Mm.
the
Mm.
sectors that are powering the economy today, last GDP figure was 2.25%. In quarter one of 2022, it was 3.1%. In quarter two of 2022, GDP grew to 3.54%. But in quarter three, what happened? GDP dropped to 2.25%. And if you check it, you will see that the agri sector also dropped.
Mm.
Manufacturing dropped. The only sectors that are powering the economy today are the services
The
sectors.
telco stream, yeah, services.
Exactly, ICT, telecom sector, the financial services sector. These are the sectors powering the economy. Unfortunately for us, the employment elastic sectors, the reproductive sectors, industry and agriculture are not doing as much, and that's why we're
Mm.
also having this high unemployment rates. The sectors that
Mm.
are powering the economy, like the financial services sector, for example, are not employment elastic. There's a limit to the number of people that can come in,
Yeah.
to the exactly compared to agri, compared to manufacturing. So we need to pay more attention to the productive sectors of this economy so that inflation rate can also come down. Because it's only when we produce more that prices, when you have a supply, a lot of food output out there, okay, of course, the equilibrium price will come down.
Calm down.
Exactly.
Sincerely speaking, Prof, you have been giving us that insight into this inflation, you know, just breaking it down. And I want to believe while you are giving some of the explanation, you've been able to pick on the triple A question. That's Dr. Abel is saying, asking of other investment instrument and the opportunity that one needs to. I think you mentioned the CRR, the liquidity, the open market. Or you have other contribution to address his question, sir?
Yes, thank you so much, our senior professional. I guess that's
Yeah,
in terms
Dr.
of.
Abel Asai, Triple
Okay,
A.
so yeah, thanks for the question. You see, when you have very high inflation rates, you now begin to look at what asset classes, you know, can you invest in to give you returns that are higher than inflation rate. Usually, there are some asset classes that move in tandem with inflation. A good example is commodities. So when you have an economy that's experiencing high inflation rate, you find people now, um, especially when the real rate of return is very, very negative for financial markets, they move investments to commodities. Commodities, provide very high returns, but of course the risk is also high. In finance, as you all know, professional colleagues, the higher the return, the higher the risk. Okay. Another asset class or investment area that people tend to also do in times of high inflation is a property, real estate. So because we know that that's also one area that usually appreciates in value rather than depreciating. So commodities, real estates are there, and uh, as a way of hedging against inflation too, um, some investors also do dollar denominated assets.
Awesome.
Okay, so by investing in a dollar denominated asset, you're not only hedging against inflation, you're also hedging against exchange rate. Now, let me say this: there's a correlation between inflation rate and exchange rate. Okay, that is what studies have shown. In countries where inflation rate is high, you should also expect that exchange rate to be high. As a matter of fact, we have a theory that backs that. The under purchasing power theory, I'm sure you all know of the law of one price. But there's also a theory, an aspect of PPP that says that the exchange rate of any country is a function of exchange rate between two countries is a function of a function of the two countries' inflation rate. So
Mm.
the exchange rate between Nigeria and Nigerian naira and the US dollar is a function of the inflation rate in Nigeria, domestic, and in the
And
US,
you,
foreign. So the higher the inflation rate in Nigeria, the higher the exchange rate will be. That is what it says. So there's a connection between exchange rate and inflation. So when inflation rate is rising, you can buy dollar denominated assets to hedge against exchange rate risk and to hedge against inflation rate risk. Okay.
great,
People
great.
invest in euro bonds. I'm sure you know about euro bonds.
Yeah,
Eurobonds,
yeah.
Eurobonds are today are also traded in the Nigerian capital market because usually when the government issues Eurobonds, eventually the government gets them listed on the Nigerian exchange. So you can invest in Eurobonds, you can invest in other dollar denominated assets to hedge against inflation and exchange rates. You can invest in commodities. You can invest in real estate. I'm talking
Great.
about investing in dollar.
Opportunity. Yeah.
Yes, dollar denominated assets. I mentioned one of them is euro bonds, and I'm sure. Please don't do any investment without proper advice. I won't advise that because inflation rate is high, you go and start doing you put in so much money in a cryptocurrency. Cryptocurrency can also, of course, give you very high return above inflation rate, but remember too that the risk is there,
It's
very
high.
high risk. Yes, and that's why we recommend that even if you're doing cryptocurrency, let it, as a rule of thumb, let it not be more than 2% of your entire portfolio size. So if you have 100 million naira to play around with, for example, just 2% of that, okay, that should be around 200,000 naira. Should not, don't do more than that in cryptocurrency because of the high risk, and then of course ensure that your investment is diversified to be able to minimize risk, whether it is coming from inflation or
Great.
coming from exchange rate risk.
Great, great. Sincerely speaking, aside you giving us insight into some of these things, I can see you even giving us consulting work so that you can, our professional colleague can be guided on some of
Yes.
the things that they need to do. Thank you very much. But let me ask you about some technical word when we come to inflation, and that is words like reflation, deflation, stagflation. What do they mean in relation to economics of individual, corporate organization, and the nation?
Okay, let me start with I've talked about inflation, and
Yeah.
then there's also a term we call disinflation. Disinflation. Okay.
Okay.
Now, disinflation is what we witnessed in December.
Hmm.
In December, inflation rate dropped
Yeah.
from 21.47% in November to 21.34% in December.
Three.
So it dropped year on year. Year on year means compared to the corresponding period
Previous year.
the previous year. That's year on year. So when inflation rate is dropping like that, it is called disinflation. That doesn't mean
Hmm.
that prices are not rising. Prices are also rising, but they are rising at a slower pace.
Great.
That is disinflation. Now, the opposite of inflation is deflation, the one you talked about, deflation. Deflation is when you're
Yeah.
computing, this inflation rate, we compute it using what is called the consumer price index
Yes.
CPI.
Yeah.
Yes. An index is nothing but a measure of change, the rate of change from one period to another. That gives you an index. And usually, you all know this. We have types of indexes. We have the last payers method. We have the past method. The National Bureau of Statistics, in computing consumer price index, they uses the last payers method. Now, deflation is when you compute inflation rate, instead of the price rising, you have a decrease. So
Hmm.
deflation is decrease in price. Inflation is increase in price.
Increase in price.
Disinflation is increase in price at a slower rate.
Hmm.
Yes, I also heard you mentioning stagflation.
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 Yes, sir.
Yes.
Stagflation.
Now, stagflation has two words. The to stagnate and inflation, combined, to get stagflation. Stagflation is where you have inflation rate rising, and at the same time, you have the economy being stagnated. The economy is not growing, or the economy is even contracting, and then you have inflation. We witnessed that in 20 during the COVID.
Hmm.
Okay, and
Yeah.
well, we're also partly witnessing that now. You see, what your theory says is that if you have high rate of inflation, okay,
Hmm.
what is when we talk about recession is nothing but in economic activity, when you have a general slowdown in economic activity, when you have GDP dropping negatively for two or more
A
consecutive quarters, you
consecutive
have
time.
recession. Is that not so? So
Yeah.
when you have the economic output GDP, if GDP is declining or stagnating, and at the same time you have inflation rising, that's stagflation. That is a
Okay.
double whammy, a
Hmm.
double jeopardy.
Hmm.
Okay,
Hmm.
so countries seek to you want to have a lower inflation rate, and you also want to have a higher GDP, the growth rate. But in this
Hmm.
country, what do we find? GDP is growing below population growth rate, and
Hmm.
inflation rate is rising. So it's very easy to see why poverty rate is rising. It's very
Hmm.
easy to see
Hmm.
why unemployment rate is rising.
Hmm.
Particularly if as I said earlier on, if you have a problem with the structure of the economy today is tilted more towards services. We have
Service.
three
Yeah.
main components of an economy has three main structures: services, industry, agriculture. And I'm
Hmm.
saying our economy today, because it tilts more towards services, over 54% of GDP is services. Okay, the other ones are not growing as much as services. As a matter of fact, industry sector is in the negative territory in terms of growth. So in that kind of situation, you can have inclusive growth. You can have high employment rate, and you're also likely to have high inflation rate. So we need to fix the structure of the pay more attention to production, pay more attention to manufacturing, to
Great,
agriculture, especially
great,
the
great.
value adding ones. Okay,
Mm,
and
mm.
de-emphasize. I'm not saying we shouldn't give attention to services. Services sector on its own, okay, can be auto-driven. Even when you don't do it, push it, it will
Push
on its
it.
own it
It
will
will
move.
move. It will move.
Yes, to move. What it just requires is the enabling environment, enabling laws, financial services sector, ICT, all this will take on their own. But manufacturing
Mm.
sector needs help. Agri sector also needs
Agriculture.
a push. Yes,
Mm.
and that's what the new government should take a lot more seriously.
Prof, I'm taking that out of him, and I'm going to combine the question from Shuaib with your last statement. Shuaib is trying to find out that what is the effect of election on the inflation rate, and I too want to ask that. I'm sure you know we are in the election period, just in line with what Shuaib is saying. That what would be your suggestion, assuming that we have one of the big player in this election? What would be your suggestion in this worsening inflation on Nigeria economy today?
Yeah, thank you so much. Yes, what's the effect of election on inflation? It's usually um, we usually see a correlation between the two in terms of an increase in inflation rates. I think if you check historically, usually around election period, inflation rates tend to rise. And if you read the monetary policy communique by the MPC, central bank's MPC, this last one, that is one of the reasons they gave for increasing the MPR,
Mm,
because election periods are associated with increased spending by politicians. And that's why the central bank is thinking that if they don't increase the MPR now, in order to reduce the money in circulation, inflation rate might spike. So that's also why
mm.
part of why they increased them in order to guard against this election spending. And I also think, even though it is not clearly stated as one of the objectives,
Apology for that. There was a slight
yes,
destruction. Yeah,
yes,
but
yes.
please
Can I go ahead? Can you hear me?
go, go ahead. I'm hearing you very
Yes,
well, sir.
yes. I was saying that yes. I also think, even though it's not clearly stated as one of the objectives, that this cash withdrawal limit, the currency redesign and cash withdrawal limit, is also meant to check, money circulating outside, and then reduce the money that will be available, outside during this period. So the effect of election on inflation is, in our climate in Nigeria, is usually to push up inflation because of too much money, in circulation, and that's why the central bank is increasing MPR, and in my view too, partly why the cash withdrawal limit and the currency redesign is there, because currency redesign is meant to mop up out what a lot of money outside the banking system, into the
Yeah.
banking banking system. Then what should be done? My advice to the incoming administration is to address the causes of inflation in Nigeria at the root. Okay, as I said, it's not essentially a monetary phenomenon. It's not completely a monetary phenomenon. There could be aspects of it that, of course, is monetary, which the central bank is expected to handle, but predominantly the causes are what we find out there. The issue of fuel subsidy. is something we can't run away from. We have to find a way to end fuel subsidy. Yes, in the short run, it could also lead to inflation, but in the medium to long run, this country will be better for it. We'll have more investments in the oil sector, in the downstream sector, and the competition can come down. The issue of exchange rates, multiple exchange rates, has also come up. The new administration should also ensure that there's only one exchange rate window, instead of having multiple exchange rates that is discouraging foreign investors from coming into Nigeria. Because, of course, if you have foreign investments coming to Nigeria, especially when they come in and set up factories, of course, you create jobs, and inflation rate can come down. So these two key issues are important for the next administration. The issue of subsidy, so that we should stop importing fuel in this country. Thank God Dangote refinery is coming on stream, because if we don't end fuel subsidy, you won't have more investors in the in Nigeria, particularly in the downstream sector. So we need to fix our refineries, or if we can't fix the refineries, we'll get them private. Government should hands off.
Privatized.
Yes,
He,
issue of
he,
refineries. Yes.
Prof, it's been a very insightful time. You took us to class, brought us back again with practical things, talking and guiding us on things to do. But in 1 minute, which is in closing, ICAN, your institute, is always open to ideas that will positively impact and advance the growth of our members, the accounting profession, and the Nigerian business. Just in a minute, what is your suggestion for our institute, even on this issue of inflation, to the members and the institute at large?
Now, my suggestion is that the institute should, at all times, have a position on burning economic issues. Okay, we should know the position of our institute with respect to how to tackle inflation. We should also know what's the position of our institute regarding some of these the myriads of economic issues facing the country. What's the position of the institute with respect to subsidy, with respect to multiple exchange rate, with respect to? I'm aware that I think the institute it has been issuing in time past,
Yeah.
issues statements in that direction. We should intensify that, such that when the new person comes in, that new administration will now know that yes, ICAN also has materials that can also help. And when they are making their appointments, they should realize that the very competent people, can be found within the ICAN family. So if you're appointing your Minister for Finance, you're appointing your economic team, there should be ICAN members, in those teams. I tell you what, I'm an economist. I have a master's in economics, as you can see. I'm also an accountant. I'm a chartered accountant. And okay, to run the Ministry of Finance well, you need a chartered accountant.
Brilliant,
Because
brilliant,
yes,
brilliant.
I can tell you that because I was a commissioner in of finance in my
Imo
state.
State.
Imo State, yes. It is the commissioner, is the chartered accountant that will understand what they do at the Accountant General's office, because the Ministry of Finance oversees the Office of the Accountant General. It is not the somebody with another discipline or another field that would understand that. So when appointments are made, chartered accountants should be considered for those,
That is a very brilliant way, my prof, to bring this show to a close. Time is not always my friend. Each time I have erudite scholar coming on the show. But one thing I know is whenever we call on you, you are always there to enrich the knowledge of our member. I want to say a special thank you to you, Prof. Uche Waleke, FCA, for sharing your evening with us on ICAN on Air. Thank you very much. And to all our viewers that are connected globally and every part of the country, thank you very much for always being there every Tuesday and Thursday. I promise you that next week, Tuesday, is going to be another insightful time. But remember, don't forget, as you are getting your package for end of the month, set aside your subscription for the Institute so that we can move on. For the ACA, 17.5. For the FCA, 32.5. And for those that are due for fellowship conferment, plug into it. Until I come your way again next week, Tuesday, I remain your host, Olusesan Okunade, FCA. Bye for now.